Am I audible now? So, yes. So ratio is what actually mathematically ratio is that which tells about the relationship between the two numbers or two variables or two people, two functions. Okay. So the one represents the proportion of which or percentage of which it is in the second proportion of the second variable or second number or second person. So that is ratio. Actually, we express the ratios in the form of percentage, like 10%, 20%, 30%, or in the form of fraction, 1/5, 1/3, 1/4, half. Okay. Whereas ratios we also can express in the form of what you call proportion. 2:1, 1:1, 3:4. In that proportion also we express the ratios. Okay. So this ratio analysis, we understood what is ratio. Now what is analysis? Analysis is what? Analysis is the complete understanding, means study of work on logical classification and analysis arrangement of the given information in a proper order in order to get the required solutions. Okay. Analysis in business terms, analysis is arrangement of the data, bringing the relationship in a system between the various variables of financial statements in such a manner to analyze and assess and reallocate them in order to understand the meaning of the relationship between the various items of the financial data, okay, or information statements. Now coming to the ratio analysis. What is ratio analysis? Ratio analysis is that process of, I'll show you the screen. Ratio analysis is the process of computing, determining, and interpreting the relationship between the component items of financial statements. That means what we do, we compute, determine, and interpret the relationship between the various components that are in the financial statements. Okay. Say for example, current assets and current liabilities. If you take current assets, current liabilities, through current ratio, we will discuss the current ratio and current, like the relationship between the current assets and current liabilities. Understood? So generally, this has been defined as a systematic use of ratios to interpret the financial statements so that strength and weakness of a firm as well as historical performance and current financial conditions can be determined. So the ratio analysis is defined as it is a systematic use of ratios to interpret the financial statements. So we use the ratios in a systematic manner. Why? To interpret the financial statements information. Again, put a question, why to interpret? In order to know the strengths and weaknesses of the firm as well as its past performance and current performance. Okay, there is the entire process we can call a systematic process, or when you implement it in a systematic manner, we call it as a ratio analysis. Okay, generally financial ratios are widely used by various users for various purposes. We'll look into the uses of financial ratios in the next forthcoming slide. Now let us look into objectives of ratio analysis. If you look into the objectives of ratio analysis, the first one is standardize the financial information for comparison. Yes, whatever the information provided in the financial statements, that information is required to be made in a standard format. It means comparison. If you want to make a comparison, inter-firm comparison or intra-firm comparison, whatever the comparison, if you want to make a comparison, there should be some standard method of comparison, right? So in order to standardize this, comparisons for financial data of a company, we use ratios. Okay, then evaluate the current operations. I already said in the definition itself, only it is there. Ratios help to evaluate the past data as well as the current data and future data also. Okay, like based on the present information, analysis of present information, you can also estimate the future data. Okay, the next one is compare the current performance with the past performance. If you use comparative statement, common size statement, how you use comparing increase or decrease in previous class we discussed. Here, we are doing ratios using certain formulas, taking the 2 years values of the components from profit and loss account or components from balance sheet. We do comparisons. So this comparison will make possible to understand how the firm performed in its past and in the current period. Okay, so that the management can take a able decision. The next one is compare performance against other firms and industry standards. Yes, it's a comparison of not only the inter-firm comparison, or it also enables intra-firm comparison with other organizations also can be compared. Taking the other organization's financial data and our financial data, you can make the comparison of profit and loss components or balance sheet items for both the companies, so that you can estimate, analyze, and interpret the performance or the operating efficiency of both the organizations. Next is to study efficiency of business operations. I just said this. When you are able to bring the comparisons of your inter-firm operations or comparison with the outsider or firms, automatically this comparison, the results of the ratio analysis will enable a person to know how efficiently an organization is working, which organization is working efficiently, or in which year organization performed its functions efficiently. This can be, if the operational efficiency can be analyzed effectively. Okay, the next one is to study the risk of business operations. Yes, it's this ratio analysis, while with the help of comparison of inter-firm results or inter-firm financial statements or inter-firm financial statements, we not only analyze the efficiency of organization or performance, operational efficiency of the organization, we also can understand the risk that the organization is working under. Okay, because if the reports are below the standard, say for example, for current ratio, there has been a standard has been given for the current ratio. That standard is 2:1 is the ideal standard for current ratio. So when you do the current ratio for your firm data or any other company's data, if the ratio that you got from the figures got taken is less than this standard, means it is under the risk. Okay, so that is how the ratio analysis not only helps in identifying the operational efficiency, but also helps in risk involved in the business operations. How, to what extent of risk these business operations are, we can analyze. The next one is to simplify the comparison of financial statements and summarize the large number of figures. Yes, see, in comparative and common size statement, what we are doing, item wise, like component wise, we made the comparison in the comparative statement taking 2 years. In common size statement, in each of the component, in the total percentage of each of the component in the total liabilities or total assets or total sales we calculated. It's a lengthy process, but whereas ratio analysis not only avoids that lengthy process, it simplifies the system of comparison by summarizing the large numbers into small. Okay. And the next one is highlight the changes in financial position. Of course, it's not only financial position, financial performance also, because we can do only the profit and loss account components analysis. We can do only the balance sheet components analysis, or we can do a combination of both profit and loss account and balance sheet analysis. So this helps to identify the changes in the overall financial statement, the position of the company. So these are the objectives of a ratio analysis. Coming to the importance of ratio analysis, why people go for ratio analysis, or why ratio analysis used as a wide tool, set as a wide used tool of financial statement analysis. If you look into that, the importance, the significance, why do people use it much wider than any other type of financial statement analysis tool? So, because it provides various information required by various users of financial statements. So, and in a very good way. Of course, these analyses are done by the financial analyst, but the financial analyst using or with the help of ratio analysis will provide various information that are required by the various people. Let us look into that. First one is creditors, short-term creditors. Short-term creditors, who are the short-term creditors? Suppliers, or the creditors who supply money for a short period of time. This comes under the short-term creditors. Okay, and why do they want to know the in a detailed manner about the company? Because they are the one who is lending money or lending goods on credit. So they want, before lending, they want to know what is the actual ability of the company in a payment or meeting its obligations, current obligations. If you are able to meet, if you are credit worthable, then I'm ready to give you the credit. If you are not credit worthable, I'll not show interest to give you the credit. Same the way in a organizational level. So creditors, short-term creditors. Who are the short-term creditors? Suppliers and short-term lenders. Okay, fund lenders. Why they want to know the deeper of the financial statement, or why do they use ratio analysis? Because they want to know the ability of company in meeting its current obligations. Then what type of ratios they use? Current ratio, quick ratio, absolute quick ratio. They use in order to identify the immediate ability of the company in meeting its immediate obligations. The next one is for long-term creditors. Who are the long-term creditors? Banks, financial institutions, or any other companies who lend money to the company for a long period of time. Okay, and now why do they want to know about the company? Why do they use ratio analysis? Because ratio analysis helps them in identifying the ability of company in regular payment of interest and repayment of the loan on due date. So I'm the lender, I'm a bank. You came to me asking for a long-term loan, 5 years long-term loan. Then as a banker, will I give as it is? No. Before giving a loan, I want to know what is your ability. Because it's a long-term loan, so you are supposed to pay regular interest. And at the end of the period, expiry of the loan term, you are supposed to return my loan amount also. So these two, I want to know first regarding you before sanctioning the loan. You in the sense company. So as a lender of long-term loans or credit, bankers, financial institutions, or any other companies will look into ratio analysis. So for what purpose? In order to know the ability of company in regular payment of interest and also repayment of loan and expiry. For these two purposes, they use the ratio analysis. And then what type of ratios they use? Solvency ratios. Under that, you will get the debt equity ratio, proprietary risk ratio, okay. Then interest coverage ratio, all these ratios you will get. These ratios tells about the ability of company in meeting its regular its loan obligations. And so the next importance is for management. Yes, the other important people or the user of ratio analysis are management. Management, who are management means board of directors or the people who involve in decision making. Any people who involve in decision making are said to be management, like board of directors, managers, top level management. Okay, these top level management wants to use ratio analysis. Why do they want to use the ratio analysis? Being a top level management, in order to take future decisions and make future plans, they want to know the operating efficiency of the organization and performance analysis of the employees by using of various ratios. Okay, so they use this. And what type of ratios they use? Mostly profitability ratios, like gross profit ratio, net profit ratio, operating profit ratio, like that. Various ratios will turnover ratios also. Okay, for the management, activity or turnover ratios. Efficiency of the various assets and efficiency of the management in converting its assets or the resources into sales and then into cash. To study this, management will use the ratio analysis. So what type of ratios? As I said, as profitability ratios and activity or turnover ratios. Now coming to the last but not least, users of ratio analysis is owners and investors. Who are the owners? Shareholders. The one who contributes capital to the firm are said to be owners. That is, in case of companies, owners are shareholders. So shareholders, as an existing shareholder and prospective investors, means the new investors who wants to invest in the company shares. These are the people who also show interest in understanding the company's financial statements and use the ratio analysis. And so why do they use? As their owner and the prospective investors, what purpose they want to, for what purpose they study the financial statements through ratio analysis. If you look into that, why? Because as an investor, I would like to say, as a prospective investor, I would like to take a invest in your company. Before investing, I would like to know and take the decision whether company is performing well or not, considering your past performance and various profitability position, all decide whether to invest my savings in your company or not, buy your shares or not. So that is how prospective investor wants to know the users ratio analysis. What about the existing shareholders? Being an existing shareholder, I would like to know to what extent I'm going to get returns on my investments in the company, and whether a company is performing well or not. Should I continue in the same company or should I sell my shares of this company? To take these kind of decisions, existing shareholders would like to know. So investors and shareholders, prospective investors and shareholders are the users, and they want to take, in order to take the decisions to continue or not to continue, or to invest or not to invest in the company, use the ratios. What type of ratios they use? Profitability ratios based on sales and based on profit. Whatever ratios are there, these ratios they use and will decide to take the decisions. That's about. Now coming to the advantages. As children, advantages, simplification of financial statements, I already said under the objectives. Okay, facilitates inter-firm comparison, intra-firm comparison, helps in planning and forecasting, helps in investment decisions. All these, whatever objectives are there, same in the form of advantages, we will write. Coming to the limitations. Limitations are that ratio analysis is made with the help of the data provided in the ratio, the financial statements, recorded and past data, whatever is available in the financial statement, based on that only it provides. The next one is quantitative analysis. Ratio analysis does only quantitative analysis. Okay. Interform comparisons is made possible and will be successful only when do with the similar size of the organization, nature of the products, and everything are similar. Then only it is give more accurate results. Next, price level changes. Though ratio analysis tells the performance, efficiency, operating efficiency of the company, but due to the price level changes, this may not give the accurate results. Okay, lack of adequate standards. As there are no standards specified for certain ratios, ideal ratios are not there for certain ratios. So it is very, there is no thumb rule also. Okay. Like current ratio, if you take 2:1 is the standard, but this 2:1 is not suitable for all the organizations on the industry. For certain organizations, it may be even 1:1, or if it's not there also, they will run, or it may be beyond that. It may require beyond that. So ratio, it is only, there's no lack of adequate standard. Next, personal bias. Yes, because how do you calculate, how do you use your formula, and what all you method, which method you use while deriving the required solution depends on the financial analyst decision. So there is a possibility of personal bias. Next, limited use of single ratios. Majority people use only single ratios, which may not give accurate results. Now coming to the classification of ratios. Ratios may be classified on the basis of importance, primary and secondary ratio, on the basis of source, like what you call from where you are taking the information, profit and loss account or balance sheet, or from the board, or on the basis of nature of items. Okay, like current assets and current liabilities, you are taking capital ratio, you are taking sales, you are taking, okay, that like that, depending on that, this continues. Now let us see, and we have the major type of ratios are classified into 4 types. The major classification is 4 types. First one is liquidity ratios. Okay, after liquidity ratios, second we have solvency ratios. The third one is activity or turnover ratios. Fourth one is profitability ratios. Again, under each of these ratios, we have different types of ratios and formulas, for which I'll share you the link along with the solutions, okay, in the group. Tomorrow's class, I'll share this link of the document. Okay, now I'm sharing screen. Please turn over page number. Yes, I request everyone, those who are having, yes, you can use this is for materials, university materials. Please open page number 102. 102. Okay, please open page number 102. We work out 2 problems. Here you have been given 3 problems and many illustrations. I'm working 2 problems now. Yes. Yeah, please look into the question given in the study material, page number 102, question 1. Okay, you have been provided with the sales, gross profit, cost of goods sold, opening stock, okay, and closing stock, debtors, net profit, net fixed assets, right? And asking you to calculate gross profit ratio. How do you calculate gross profit ratio? There is a formula given to us. Okay, gross profit. I hope this screen is visible. Yeah, gross profit by net sales into 100. Okay, so in the question, gross profit has been given directly. The net sales are 3 lakhs into 100. Okay, so if you cancel, you will get 20%. Because I told you profitability ratios, we calculate whatever the result you will get, we'll express in terms of percentage. And remember, we multiply with the 100 in order to express. Okay, the next one is calculated as net profit ratio. Net profit ratio. Okay, this next profit ratio is that net profit by net sales into 100. Okay, so net profit given to us in the question 28,000 by net sales. Here it's given already in the question only 3 lakhs into 100. I already told profitability ratios we express in terms of percentage. So we multiply with 100. Okay. So 3 zeros cancel, 2 zeros cancel. 3 in 28 goes 9.33%. Okay. 9.33%. Okay. Now the next one is that the next ratio is that debtors turnover ratio. This comes under the turnover ratios. Turnover ratios we express in terms of time. Turnover ratio. Debtors turnover ratio equals to debtors. Debtors means who? Customers to whom we sold goods on credit, right? So what we should take? Credit sales. The relationship of debtors with the credit sales. So credit sales, net credit sales divided by average debtors. Children, how do we get net credit sales? Actually, net credit sales we do get, how you get? Total sales minus cash sales minus sales returns. If you do, you will get net credit sales. In absence of all these information, whatever the sales given in the question, that itself has to be taken as net credit sales. Okay? And how do you get average debtors? Average debtors. Average debtors is opening debtors plus closing debtors by 2. Always remember, how do we take out the average? We take out the average by adding all the given values divided by number of values. So here average debtors we take opening debtors plus closing debtors by 2. Okay. So in absence of opening and closing debtors, whatever closing debtors are given or whatever the debtors are given in the question, that itself has to be taken as average. Okay. Remember, if both are given, opening plus closing by 2 we do, and we get average debtors. If both are not given, only one debtors are given, then we will take that itself as the average directly. Again, don't do by 2. Now in this question, credit sales. See here, we have been provided only one information of sales, that is sales 3 lakhs. Okay. And data, what do you call the stock turnover ratio, data's turnover ratio. But data's also only one information given, that is data's. So sales 3 lakhs divided by data's 32,000. Okay, please do multiplication, division. So 32 in 300, how many times goes? Please calculate and tell me. How many times it goes? Uh, 300 by 32. $9.375. 375 times. For data's turnover ratio, we express the answer in times. Okay? Very good. 9.375. Very good. After that, we have, I skipped the stock turnover ratio, which also is called as an inventory turnover ratio. Okay? We call it also as a inventory turnover ratio. Right. Inventory stock turnover ratio. The new name is inventory turnover ratio. So how do we get same? Stock on the basis of cost of goods sold. We usually do cost of goods sold divided by average stock or inventory. How do you get cost of goods sold? There are two formulas to get the cost of goods sold. One is sales minus gross profit, or opening. You do this trading account, right? In trading account, if you take out the gross profit, whatever is there, sales, say minus sales returns, and then closing stock on credit side, and debit side purchases, opening stock, and direct expenses. The difference, whatever you get, that we call as the sales, right? So without taking that, without taking the sales and gross profit, whatever is there, opening stock plus purchases plus direct expenses minus closing stock. If you do, you will get a what you call cost of goods sold. This is cost. I'll write fully cost of goods sold. Okay. Other easy way I'll make you remember. I'll remind you. In your previous semesters, you prepared trading account, right? On debit side, you used to take opening stock, purchases minus purchase returns, and other direct expenses, whatever are there, wages, carriage in, right? Wages, carriage in, all those. On here on the credit side, you will take sales minus sales returns, closing stock. So the difference of these two is going to be your gross profit, right? Forget about gross profit, forget about sales. Add these all and minus this closing stock, you will get a cost of goods sold. This is another way to remember, because you already worked out with the trading account in your previous semesters while doing financial statements. So this method is easy. Opening stock, add opening stock to the opening stock, add purchases. If any purchase returns are there, minus from the purchases and take net purchases. Direct expenses, whatever direct expenses that we take in the trading account, that's going to be recorded here. Then subtract the closing stock, you will get a cost of goods sold. In absence of cost of goods sold, the given sales itself only to be taken. If you are being given sales and gross profit, then you are supposed to take cost of goods sold using this formula. Okay, or if you have been given this information using this formula, you are supposed to find the cost of goods sold. Nothing is given, only sales information is given, then this is itself. So it is either cost of goods sold or sales. But when you will go for sales, when in absence of cost of goods sold information. But for us in this question, cost of goods sold related information directly given to us, 2,40,000. So stock turnover ratio equals to cost of goods sold 2,40,000 by average stock. Average stock, here we have been doing opening stock plus closing stock. So how do you get average stock? Average stock opening plus closing by 2. So opening stock given as 58,000 and closing stock also given as 58,000 by 2. If you do, you will get a 58,000 only. So stock turnover ratio, cost of goods sold divided by average stock. If you do, you will get a what amount? Can anyone? Please calculator. What amount we will get? 58,000. Okay, dear. Divided 2,40,000 divided by 58,000. 240 divided by 58. 4.137. 4.137. So what is this called? Which ratio we calculated? Stock turnover ratio. Turnover ratio is what I said. We measure in times. 4.137 times. This is how you are supposed to write. Okay? Understood? 4.137 times. Now next, let us see the next ratio given to us is fixed asset turnover ratio. Fixed asset turnover ratio. What is the fixed asset turnover ratio? Tells us the ability of company in converting its fixed asset into sales. Means how efficiently it is using its fixed assets to convert into sales is what this fixed assets turnover ratio tells us. Okay. So what are fixed assets turnover ratio? So how do we do this? Sales divided by net fixed assets. Sales divided by net fixed assets. What does it mean by net fixed assets? Gross fixed assets minus depreciation. If you do, whatever you get, we said to be net fixed assets. Okay. So here net fixed assets are directly given to us in the question, 2,10,000. Right? Okay. Sales also given to us in the question. So what is the fixed assets turnover ratio? Sales 3 lakhs divided by net fixed assets 2,10,000. So can someone please 3 lakhs divided by 300 by 210? One point. Right? Okay. $1.428. What we should write? Times. Times. right? So now this is the first question solution. Okay, so children, remember turnover ratios we also call as activity ratios, which tells about the ability of company in converting its assets or resources, whatever resources, into sales. Okay, and profit we express in times. Understood? Next one is profitability ratios. In this question, we have been provided with the profitability ratios. Profitability ratios means what? Profitability ratios tells about the performance of company during that particular year. Performance of a company during that particular year. How company is making profits. Okay. Now, let us solve the second question. In the same page 102, second question. Yeah. In page 102, generally in examination, you will get first question kind only. Like data, some data will be given to you, and based upon that data, you are supposed to solve the required ratios. Okay. And second question is that you have been provided a liability, a balance sheet information, and some additional information relating to sales, cost of goods sold, net profit before tax, after tax. And you are asking to calculate various ratios. Okay, let us calculate first the current ratio. How do you get current assets by current liabilities? So you must know what is the list of current assets and what is the list of current liabilities. In previous class, I showed you the company's annual report, and that I told you also there, you should remember the list of current assets and current liabilities in order to do this ratio analysis. Okay. So current assets, let us list the current assets as given in the question. What are the current assets given? Debtors, closing stock, cash in hand. Write down cash in hand. These are the three items given to us in the question. So write down the components that you have taken under the current assets. After that, put the value 5,37,500. Plus closing stock 6,45,000 plus cash in hand 1,07,500. Add these. $12,90,000, right? 12,90,000 in must be 38, 45, 90, 5, 6, 11, here 12. 12,90,000 is the current asset value. Current liabilities. What are the current liabilities given to us? Creditors, bills payable, outstanding salaries, plus provision for tax. These are the current liabilities, right? Okay. Now, check the values. So I'm telling you, writing first write down the formula. After formula, write in current assets. What are the components that you are taken under the current assets? What are the components that you are taken under current liabilities? You are supposed to show first. If you skip this step also no problem. Directly if you write is also okay. Because what are the items that you are taken, you are already writing here. So this step is not necessary in case of time limit. Okay, you can directly write the total figure. So creditors, bills payable, creditors 1,29,000, bills payable 2,50,000, 21,500, 2,79,500. Add and tell me. 1,30,000, 1,30,000, 3,30,000, 3,45,000, 3,45,000, 5,45,000, 6,25,000. I think 6,25,000 current liabilities. Very good. Right. So now after this, directly substitute the values in the formula. Current ratio equals to current assets 12,90,000 divided by 6,45,000. The answer is current ratio comes under the liquidity ratio, guys. So liquidity ratios we express in terms of proportions. Okay, 2:1. See, this is 2 times 1 time. 1 645 are 1 645. 645 2s are 1290. That is how 2:1. In a proportionate value we discuss 2:1. Current ratio you are supposed to express in this way. The next one is quick ratio. Quick ratio, how do we get? Quick assets by current liabilities or quick liabilities. Quick assets, how do you get quick assets? Current assets minus stock or inventory. Current assets minus stock or inventory. If you do, you will get quick assets. Okay. Now, current liabilities. Quick liabilities, how do you get? Current liabilities minus bank overdraft. In case it is there. If bank overdraft is there, you are supposed to minus the bank overdraft from the current liabilities. Then you should take the quick liabilities. If there is no bank overdraft is given, in absence of bank overdraft, you can take current liabilities directly to calculate the quick ratio. Okay. So now for us in the question, current assets are there from which we are supposed to subtract the stock. So quick assets equals to current assets. Here itself we calculated 12,90,000 minus stock. What is the value of stock? 6,45,000. So what is the value of quick assets? 6,45,000. Quick assets are 6,45,000. Current liabilities we take 6,45,000 only because in this question we don't have bank overdraft. So current liabilities itself we will take. So here quick ratio equals to quick assets by current liabilities. So we got quick assets 6,45,000. Current liabilities are also equally 6,45,000. So one time, it is 1:1. Quick ratio equals to 1:1. We express in proportionate manner quick ratio, current ratio. The next we have been provided with cost of goods. What is this? Gross profit ratio. I showed you gross profit ratio already. Okay. The C1 is gross profit ratio. C1 is gross profit ratio. Which is gross profit. How do you get? Cost of goods sold by gross profit by sales into 100. In essence, cost of goods sold also you can take. Okay. So gross profit. How do you get gross profit? In question, you are not been provided with the gross profit. So how do we get gross profit? Sales minus cost of goods sold. So sales are given as how much? 64,50,000 minus cost of goods sold given as 55,47,000. So what is the gross profit? 9,03,000. Right? 9,03,000. Is that 9,03,000? Yes. That is 9,03,000. Okay. Now gross profit ratio equals to 9,03,000 divided by sales. You can take sales or cost of goods sold. In sales of cost of goods sold, we will take that. Cost of goods sold is how much? 55,47,000 into 100. Profitability ratios, we always multiply with 100. Okay? Because we express it in the ratio, percentage. So please do this calculation and tell me. Gross profit ratio, 16.27%. Very good. And do the same using sales. Gross profit ratio to sales. 9,03,000 divided by sales, 64,50,000 into 100. Do this with the sales. If you are taking cost of goods sold, this is your gross profit ratio. And if you are taking sales, your gross profit ratio is 14%. Okay, 140%. Check once again. Okay. So children, this is also kind of technique. That is what no standard format we said. You can take either cost of goods sold or sales in order to calculate the gross profit ratio. So which gives the two different values. Depending on the company's requirement, may take either of them to manipulate. Okay. Next one is that net profit ratio. Now if you see net profit ratio, what is the formula? Net profit divided by net sales into 100. In the question, you have been provided with the net profit and net sales. Yeah. Here you have been provided with two net profits. Net profit ratio, net profit by net sales into 100. Profitability ratios we express in terms of percentage, so we multiply with the 100. Net profit ratio, here we is, what we do? Net profit, two net profits are given. One, net profit before tax and net profit after tax, net sales. So which profit has to be taken down? So net profit after tax we will take always. Okay? Net profit after tax is important to take to calculate the net profit ratio. Net profit after tax by net sales. So what is the net profit after tax given to us in the question? 2,34,350 divided by net sales given as 64,50. 64,50,000 into 100. Can someone please? 234,35 divided by 64,50. Can someone please? 3.633%. Okay? 3.63, which can be said as 3.6% also. Or it can be said as 3.6%. Okay? And this based on gross profitability and gross profit ratio and net profit ratios. How do we say how the company is performing? What is the efficiency of company in earning its profits? This we will able to say based on the industry standard benchmark ratio. Okay, generally industry benchmark will be there for gross profit and net profit ratios. If a company is near or above the benchmark of the industry, then we say it is performing well. If company is below the benchmark of that industry, then we say company is like where it is going wrong or how to improve it. Understood? The next one is given as fixed asset turnover ratio. Yes, fixed assets, what do we have? Net fixed assets and net sales. We already worked out under the first one. Okay, we already worked out this under the first one. So you can do this. The next one is current assets turnover ratio will do. current assets turnover ratio. This is 35. Yeah. Till the man. Children, this is how you are supposed to go. Whatever the problems are there in your book, that if you practice are more than enough. Only the thing what comes under the ratios, various current assets means what are the current assets, different formulas to derive. See here for gross profit, two formulas are there. So both the formulas you are supposed to know, so that based on the provided information you can able to derive the required answer. Understood? Okay. The next one is, so only the thing you practice the entire textbook problems, especially ratio, every chapter, whatever the textbook illustrations and exercise questions are there, those completely practice very well. Okay, that's more than enough. With the same, you will get your exam. It's available previous question papers. Collect the previous question papers and solve those. These three are enough. You need not to refer any other books for your certificates. The next thing is that what is working capital? What is that current asset turnover ratio? Current assets turnover ratio. Okay, current asset turnover ratio. How do you get? Anything turnover ratios, what you remember? One more point, turnover ratios, the base is sales. Okay, the base is sales for the majority of the current turnover ratios. So here also sales by current assets. So what is the sales? Sales given to us 6450, and current assets we already calculated in our first formula. Can someone please repeat? Current assets we already calculated under current ratio, current assets. Okay, tell me children. Current assets we already did. Okay. So whatever the total of 12,90,000 we have. 12,90,000, no. This is yeah, 12,90,000 is the current assets total. Okay, so net sales 64,50,000 and current assets are 12,90,000. Do this and let me know. Do this and let me know. Five. That means 5 times. We should say 5 times. So current assets to turnover ratio is 5 times. Okay. The next one we have is total assets turnover ratio. Total assets means you are supposed to take total assets. Instead of current assets, we'll take sales by total assets. Total assets turnover ratio, sales divided by total assets. So sales 64,50,000 divided by total assets 43 lakhs. Whatever the answer you will get, you should mention times. Okay. Next, debt equity ratio. These comes under the solvency ratios. Debt equity ratios are said to be under solvency ratios, which tells about the long-term ability of a company in meeting its obligations. I told you, long-term creditors, we use the debt equity ratio. What is this answer? Can please someone? Now 0.6 times. Okay. Now next one is that debt equity ratio. This comes under the solvency ratios. Okay. Solvency ratios are those ratios which tells about the long-term ability of a company in meeting its obligations. So debt equity ratio, long-term debt by shareholder funds. Long-term debt by shareholder funds. If you do, you will get debt equity ratio. So long-term debt, what are the long-term debts given to us in the question? 9% debentures only. Okay, we should take 9% debentures because equity share and preference share comes under the shareholder equity. Understood? Long-term debts are only 9% debentures. So what is its value? 15,05,000. And shareholder funds are equity capital plus, here we have differential capital plus reserves and surplus. Whatever relating to the shareholders. Under shareholder funds, we take everything that is relating to the shareholders. Like both the share capitals, equity and preference share capital, reserves and surplus, any other accumulated profit, whatever there. From these, if any preliminary expenses are there, fictitious assets are there, has to be subtracted. So in this question, we don't have such fictitious assets. The equity share capital is how much? Equity share capital given to us 10,75,000. And preference share capital is 2,15,000. Reserves and surplus given as 8,60,000. Total this 90, 60, 1,50,000. 21,50,000. Okay, 21,50,000. Now, debt equity ratio. How do we get debt equity ratio? Long-term debt, how much is given to us in the question? 15,05,000. Divided by 21,50,000 shareholder fund. 3 zeros cancel. 1505 by 2150. Calculate, you will get. Okay, children, thank you. I have another class. Same way, other ratios also. As I said, please do remember. Yes. Even debt equity ratio we express in proportionate form. Okay. 0.7:1. It is below the relationship between the debt and equity itself. Right. Thank you, children. Thank you for being here. I have other class. The next class we will come with. I'll come with the cash flow statement and trend analysis if possible.